Hello, it's Big Cheds, and this is part of the Trading Encyclopedia Daily Education series on my YouTube channel at Cheds Trading. You can find me on Twitter at Big Cheds and on Bitcoin Live, where I'm a founding analyst. For today's lesson, we're going to talk about the idea of price interaction with a key level. Much of the time when the price is consolidating, it will be consolidating in between well-defined range peak and well-defined range lows. In this example, I have Solana with a $185 overhead level and support or demand right around that $140 or $145 level. Now, when the price is consolidating, there's a lot of opportunity for you to get chopped out. There's a lot of opportunity for you to jump in early. And as I like to say, for you to put the market makers' children through college. And what does that mean? Well, essentially, you're over trading and you're paying a lot of trading fees and there's not much going on. However, when you've got a well-defined level like we have here, but I'll just draw it in this example, range peak and range lows. So when the price reaches a key level, you have what we call price interaction. Now that the price is interacting with a key level, in this example we see here, you could take, for example, a long on a break of 185. You could take a short with the idea that the price will not break out. And you could do either of those things reasonably because you could define your risk close by. What does that mean? Well, if you take a long trade, for example, with the price interaction, let's say 185 level, you say, okay, I'm long because 185 just broke. Well, your stop loss can be nearby, maybe 178 or 179. If you took a short because you see a rejection or maybe there was a minor up thrust, which would be essentially a false bull break. If you took a short, you could say I'm short as long as the price doesn't get over 187 or 188. Either way, you're interacting with a key level and your stop loss is nearby. This allows you to define your risk and have an asymmetric risk to reward with limited downside and pretty good upside. So as a general rule, you want to stay patient, avoid overtrading, and wait until the price is interacting with a key level, and then you strike. Know when it's consolidating, know when it's channeling, mark out the key levels, and wait for that interaction. And that's going to help you define your risk. It's going to help you avoid getting into trouble, and it's going to help you to stop from putting those market makers' kids through college. This is price interaction with a key level. This is part of the Trading Encyclopedia Daily Education series on my YouTube, Cheds Trading. Find me on Twitter at Big Cheds and find me on Bitcoin Live. Folks, thank you. Appreciate you being here and have a great day. Big Cheds out.